traders, welcome to the TMT special edition video on the banks. And I want to briefly point out that something that we need to look at, because why? Because banks and financials are one of the heartbeats of any type of rally along with technology. But I want to go over where we are in the S&P and of course review the banks. I want to look at some yields and of course the BKX, the banking index, to see if there's a trade possible. And I do believe that there is. I do believe that there is an inflection point in the markets, in the equity markets, and that's obviously going to affect what the banks do. On Friday, we had a major blowout in yields. Yields in the overnight session in Europe started to really sell off pretty hard, and that did what? That actually pushed bonds up and really had bonds screaming pretty much all day on Friday. That's not a good sign for the banks, because obviously banks love a higher yielding environment where we do not have that. We have lower yields, and that popped the dollar up as well, okay, and gold for that safe haven trade, and that's happening now upon us. We're grossly overbought in the S&P and many other indicators, but I wanted to show you where we are in the McClellan oscillator, and that's a great gauge of overbought, oversold. And as of right now, we are not overbought at all. We're right here neutral. We have a neutral state according to the McClellan oscillator. Now, there's other RSIs and MACD, stochastics, whatever you want to use to read overbought, oversold, and they are pretty much overbought. Valuations are 17.9 times earnings in the S&P, fully valued. There's no reason for a 9-day rally other than Janet Yellen talking up the market. And sure enough, the bigger players are going to realize that, which they started to, and now they're starting to sell the market, as at least they did on Friday. It's only one day. One day does not make a trend, but I do believe that a pullback or a short-term top is actually brewing right now. All right, negative 13, that means we get down to like negative 60, 70, 80, these areas here, then we're really overbought. You could see something like this. So there's plenty of room to run to the downside before we even become overbought, okay? So now let's take a look at our spiders, because obviously, you know, spiders are a big factor. We did get a gap down, and we held that 20-day moving average. You could see we're into some heavy supply. And again, the next target's going to be that 207.14. And if that happens, you'll see the banks and financials start to roll over yet again. And again, they're pretty weak. I'm going to put 3 out there, but you'll see my meaning behind it. I'm going to put 3 big ones out there. Now, here's what happened on Friday. Compliments of stockcharts.com. You could see that the 10-year, we had the 10-year global yields in the U.S., UK, Germany, and Japan. Look what's happened. When that happens, there's a fear trade going on, and everybody looks for flight to quality, right? Flight to safety, and that's going to be the bonds, and that's going to be gold, and you know, consumer staples, and even the consumer staples. If you have a market meltdown or just a broad-based market sell-off, they're going to get sold into as well. Why? Even GDX, actually, the gold miners ETF got sold on Friday. Why? Because retail, what they do is they never sell their stocks. They try to hold on to them. So they take good money. So good GDX, let's say they made 3-4 points out of it. They sell that, and they try to salvage the bad position by putting more money into that and averaging down, that's what's happening. So you'll get an asset class sell-off on pretty much anything but except the dollar and gold. And you can see gold actually rallied on Friday. So global yields looking really, really bad, and that's doing what? Pushing bonds to the strategy. Take a look at bonds. This is a 30-year bond weekly. This trend line represents 20-year uptrend line resistance, and it's held for the last 20 years. It has held. So this is of significance. This week, if the USB, the 30-year, breaks above it and holds, I think we're going to have some trouble, because I will tell you, if that happens, it's going to be a new leg up, new renowned strength, and if that pushes that up bonds, money's going to come out of equities and roll into bonds, and of course gold and the dollar. So that's something that you really need to pay attention to, even if you're not a bond trader. But if you like trading the banks, you need to know what the bonds are doing anyway. So very important. All right, now here I overlaid, and this is really an important chart, guys. Here is the 10-year, okay, overlaid with the S&P. And usually what happens, the 10-year and the S&P kind of follow itself, right? And then they roll over. And then what happened to the S&P in February? Just literally went up, and look what's happened to yields. They go lower. That is a disconnect, okay? You're going to have revision to the mean at one point, okay? When that happens, I do believe, like I said, equities will catch up, play catch up to the 10-year. It's just inevitable. You could see it here. I wanted to show the correlation, and it is pretty much correlated, right? You could see here, and all of a sudden it disconnected. So this here, you could even point to, an R play if you had to. But you could see here that this is eventually going to play catch up to the 10-year, and that's the S&P. Look at the XLF starting to roll over, and just here I just threw Citibank on here as one of the banks, and look, that's starting to roll over. Obviously, banks do not like a lower yield environment, especially with the Dodd-Frank Act, and they can't even trade anymore. So they got to aggressively lend. How are they going to lend and make money? Not a good sign. Okay, so that is something I'm looking for, a short entry in that. Let's take a look at the bullish percent financials based off a point and figure chart, and look what's happened. Another a great indicator. Okay, look what's happened here. We have sideways consolidation pretty much all the way through March from the February lows. Okay, and now look what just happened on Friday. We got a breakout. Now that, to me, I need to see a little bit more expansion going away from the 8 MA. But if this starts to move a little bit lower, look what's happened to the XLF, starting to roll over. That's going to be a sell signal. Actually, it already has produced a sell signal. When it curls up like this, that means that there's going to be a trend change, and sure enough, it did break to the downside. So I just wanted to show that to you, that if guys are out there long or looking to get short, this is going to be probably the right time. You need to look for your entry, okay, your strategy on when to get in, your trigger, and if you're long, you better tighten up the stops or hedge against it. Here's J.P. Morgan. It's the strongest of the three banks that I put out there. There's so many more banks that look horrible are starting to roll over, but and when you're trading, what do you want to do? You want to short weak stocks, and you want to buy strong stocks. So J.P. Morgan would be the least likely to short at the moment. Okay, but you could see here we're starting to roll over, and this uptrend it's still intact, but it's barely there. Okay, and then there's the 50. So I wouldn't short J.P. Morgan. I would rather short some other weaker banks such as Wells Fargo. Wells Fargo is really one of the worst looking charts that I've seen breaking down. I mean, in the 5-day. Here's the MACD starting to break down. We're still above zero, but look what's happened to RSI. And most importantly, look what's happened to volume. Major distribution days, guys. We had 4 major distribution days, an increase in volume. So this is no joke. Now, do you short down here? Absolutely not. We don't short in the hole. Let's wait. You see, it might even get back into the channel. It might get back and fill the 2 little gaps here. This area here, it might get back to the 50. But once this does happen, create some sort of a bear flag, that will still make. And let me draw this again. Something like a bear flag like this, that'll still make a lower high from this high, and that's when you short it, and that's for lower prices. Okay, but you could see we did make higher highs and higher lows, and now what's happened? Now we're making lower lows and lower highs. Okay, so we have a trend change that's shifting right now. So I'm looking, ideally looking to short Wells Fargo is one of my favorites, and then of course Citibank, same thing. My other favorite chart. We didn't have a lot of distribution. You could see here we're still kind of green, but I do like the fact that it finally broke out of the channel. So Citibank and Wells Fargo, one of my 2 favorites to look to short. But again, guys, look for your triggers. I don't like when they gap down like this 3 days. You're going to get a short covering rally. You're going to get an opportunity to short at better prices. Is what I'm saying. Okay. Hope it helps. Come visit us at the tradingmarkettechnicals.com. Send an email to support at Trading Market Technicals if you have any questions. We put out these special edition videos bi-weekly with targets, okay, and trigger entries. So just take a look at us. Give us a call if you have any questions. Good luck out there today. Have a great day, everybody. Talk to you soon.